Ray Dalio just revealed he's held Bitcoin in his portfolio for years. But here's the twist, it's only 1% and he says he'll never add more. Not because Bitcoin failed, because of something most people aren't paying attention to. November 20, 2025, CNBC Squawk Box. Ray Dalio is sitting across from the anchors and they're asking him about Bitcoin. Again, because everyone wants to know what the guy who built the world's largest hedge fund thinks about crypto. The anchor leans in. Ray, you've talked about Bitcoin before. Do you own any? Ray doesn't hesitate. I have a small percentage of Bitcoin. I've had it forever, like 1% of my portfolio. 1%? The anchor pauses. That's it. One of the most sophisticated macro investors alive, a guy who analyzes every asset class, every currency, every economic cycle, and he's allocated exactly 1% to what many people call the future of money. So would you add more? The anchor asks. Ray shakes his head. No, and here's why. He leans forward, getting into teaching mode. Bitcoin's not going to be a reserve currency for major countries. It can be tracked. Every transaction is on a public ledger. And with quantum computing advancing, it could conceivably be controlled, hacked, broken. The crypto community explodes online within minutes. Some people are celebrating that Ray Dalio owns Bitcoin at all. Others are attacking him for the quantum computing comment. Bitcoin maximalists are calling him outdated. Gold bugs are nodding along saying they told everyone so. But here's what nobody's talking about. Here's the question nobody's asking. If Ray thinks Bitcoin has all these problems, why does he own any? Why not 0? Why exactly 1%? What does that number mean? And more importantly, what does his reasoning tell us about how professional investors actually think about cryptocurrency versus how retail investors think about it? Because I spent the last 3 days going through everything Ray said in that interview, plus his previous statements about Bitcoin going back to 2021, plus Bridgewater's actual Q3 2025 portfolio filings, and there's a story here that's way more interesting than just billionaire skeptical of Bitcoin. This is about how to think about asymmetric bets, about the difference between speculation and strategic allocation, about why even skeptics hold crypto, and about a threat to Bitcoin that almost nobody in the crypto space wants to talk about. Okay, so let me start by saying this. Ray Dalio revealing his Bitcoin position is actually a big deal. Not because 1% is a lot, but because for years people assumed he was either completely anti-crypto or secretly holding way more than he was letting on. Turns out neither is true. He's been sitting at exactly 1%, not 0, not 5, 1. And that precision matters because Ray doesn't do anything randomly. Every allocation in his portfolio is the result of systematic analysis. So when he says 1%, that number means something. It's not a rounded figure, it's a deliberate choice. Now, before we get into why he won't add more, I need to give you some context about Ray's history with Bitcoin. Because this didn't start in 2025. This has been evolving for years. And watching that evolution tells you a lot about how institutional money thinks about new asset classes. Let me take you back to 2020 and 2021. At that point, Ray was pretty openly skeptical about Bitcoin. He was making comments about how governments would shut it down if it became too successful. He said something like, if Bitcoin really threatens government control of money, they'll kill it, and they have ways of killing it. That was peak skepticism Ray, and a lot of crypto people wrote him off at that point. They said, okay, he's just another boomer who doesn't get it, he's going to miss the entire revolution, whatever. But then something interesting happened. By late 2021, Ray's tone shifted. He went on the Lex Fridman podcast and said, quote, "Bitcoin has proven itself. It hasn't been hacked. It stood the test of time." That's a very different statement than saying governments will kill it. So what changed? I think what changed is that Ray watched Bitcoin survive multiple attack vectors. He watched China ban mining and the network kept running. He watched governments try to regulate it and it kept growing. He watched institutional adoption accelerate, and he updated his view. That's very Ray Dalio. He's constantly saying strong opinions loosely held. When the facts change, update your beliefs. But even as he acknowledged Bitcoin's durability, he never became a maximalist. He never said this is the future of money, everyone should own tons of it. He maintained this measured position. And now in November 2025, he's putting a specific number on it, 1% of his portfolio. And he says he's held that allocation forever, which in Ray's language probably means several years at minimum. So let's talk about what 1% means. When you're Ray Dalio, 1% of your personal portfolio is serious money. He's worth about $15 billion. 1% of that is $150 million in Bitcoin. That's not play money, that's a real position. But it's also small enough that if Bitcoin goes to zero, it doesn't materially impact his wealth. Lose 1%, you still have 99%. You're fine. That's the key insight here. 1% is what professional investors call an asymmetric bet. If you're wrong and Bitcoin fails, you lose 1%. If you're right and Bitcoin becomes what the maximalists think it will become, that 1% could become 5% or 10% of your portfolio just through appreciation. Ray's essentially saying, I think there's enough chance that Bitcoin succeeds in some form that it's worth having exposure. But I also think there are enough structural problems that I'm not willing to bet big. Now here's where it gets interesting. In that same CNBC interview, Ray compared Bitcoin to gold. And the comparison is revealing because it shows you exactly what he thinks Bitcoin's role is and isn't. Ray has previously suggested that investors should hold about 15% of their portfolio in gold and inflation-protected assets. 15%. Compare that to 1% in Bitcoin. That's a 15-to-1 ratio. Why such a massive difference? Here's what Ray said, and I'm paraphrasing. The advantage of gold is that it's an asset you can hold and you're not dependent on someone to provide it. It's been a store of value for 5,000 years. Every civilization has recognized gold as valuable. It's fungible, it's divisible, it's portable. And critically, when you hold physical gold, you actually possess the asset. Nobody can shut off your access to it. Bitcoin, Ray says it's not the same, and this is where we get into the specific problems he sees. First problem, traceability. Every Bitcoin transaction is recorded on a public ledger. Forever, anyone can trace the movement of coins from wallet to wallet. Now, crypto people will say, but the wallets are pseudonymous, they're not tied to real identities. Ray's response would be, until they are, governments are getting better at blockchain analysis. Chain analysis companies can trace transactions. Major exchanges all have know your customer requirements now. The idea that Bitcoin is anonymous or untraceable, Ray doesn't buy it. He thinks it's actually more traceable than traditional money in many ways. And here's why that matters for reserve currency status. Reserve currencies need to be acceptable to governments. Central banks hold them. They use them for international trade, they back their own currencies with them, and no government wants its reserves held in an asset where every transaction is publicly visible. That's a national security problem. That's an economic intelligence problem. Think about it, if China held Bitcoin reserves, the US could monitor every transaction. If the US held Bitcoin reserves, China could do the same. That transparency is a feature when you're trying to build trust in a network, but it's a bug when you're trying to create a reserve currency that governments will adopt. Gold doesn't have that problem. Physical gold can be moved secretly. It can be held in vaults. Transactions can be private. That's actually an advantage for reserve currency purposes. The second problem Ray raises, quantum computing. And this one is controversial because crypto people largely dismiss it, but Ray's bringing it up explicitly. He says, with quantum computing advancing, Bitcoin could conceivably be controlled or hacked. Now let me be clear about what he's saying. He's not saying quantum computers exist today that can break Bitcoin. They don't. He's saying that as quantum computing advances over the next decade or two, there's a risk that the cryptographic foundations of Bitcoin become vulnerable. Bitcoin's security relies on certain mathematical problems being very hard to solve. Specifically, it's hard to derive a private key from a public key. Current computers would take billions of years to do it, but quantum computers work differently. They could potentially solve these problems much faster. Is this an immediate threat? No. Jameson Lopp, a Bitcoin technologist, estimates there's a greater than 50% chance it'll take at least another decade before quantum computers are powerful enough to threaten Bitcoin. Other experts think it's even further away. But Ray's point is, if you're thinking about Bitcoin as a long-term reserve asset, as something that needs to be secure for 50 or 100 years, you have to consider this risk. And right now, Bitcoin's protocol doesn't have quantum-resistant cryptography built in. Could it be upgraded? Maybe, but that's an open question. Gold, again, doesn't have this problem. You can't hack gold. You can't quantum compute your way into someone's gold vault. It's a physical asset. That's an advantage. Third problem, and this one's more subtle, dependency. Ray says when you hold gold, you're not dependent on someone to provide it. What does he mean by that? He means that Bitcoin only works if the network keeps running, if miners keep mining, if nodes keep validating, if the internet stays up, if governments don't shut down the infrastructure. You're dependent on a complex technological and social system continuing to function. And while that system has been remarkably resilient so far, it's only 15 years old. Gold has a 5,000-year track record. Ray's essentially saying, I respect that Bitcoin has survived this long. That's impressive. But calling it digital gold or saying it's going to replace gold as a reserve asset, that's a massive leap that requires assuming this 15-year-old system will keep working perfectly for the next 50 or 100 years. And I'm not willing to make that bet with a large portion of my portfolio. So that's the bear case. That's why he's at 1% instead of 15%. But here's the question I find most interesting. If Ray has all these concerns, why does he own any Bitcoin at all? Why not just zero? And I think the answer is actually really sophisticated. Ray's acknowledging that he could be wrong. He's acknowledging that despite all these structural concerns, there's a non-zero chance that Bitcoin becomes massively important. Maybe the traceability problem gets solved with second-layer solutions. Maybe quantum-resistant upgrades happen. Maybe governments decide they actually prefer transparent reserve assets. Maybe Bitcoin becomes primarily a non-governmental store of value used by individuals and corporations rather than governments. There are scenarios where Bitcoin succeeds even if Ray's concerns are valid. And in those scenarios, having zero exposure would be a mistake. So he's buying optionality. He's paying 1% of his portfolio as insurance against being completely wrong about Bitcoin's future. That's actually brilliant risk management. It's the opposite of going all in on either the bull case or the bear case. It's saying, I have concerns, but I respect the uncertainty, so I'll take a small position that doesn't hurt me if I'm right but benefits me if I'm wrong. Now, there's one more piece of this story that I find fascinating. After Ray made these comments on CNBC, Changpeng Zhao, CZ, the Binance founder, responded on Twitter. He said something like, I might have contributed a tiny bit to influencing Ray's decision to hold Bitcoin. I learned more from him in exchange, of course. So apparently Ray and CZ have had conversations about Bitcoin, and CZ is claiming he had some influence on Ray's decision to maintain that 1% allocation. Now CZ is probably overplaying his role here, but it's interesting that these conversations happened. It means Ray isn't just dismissing crypto people as delusional. He's engaging with them, he's listening to their arguments, and he's incorporating their perspective into his analysis while still maintaining his own skepticism. That's actually the right way to approach a new and uncertain asset class. Don't just dismiss it because it doesn't fit your existing framework, but also don't abandon your analytical rigor just because something's exciting and new. Hold both perspectives simultaneously. Let me show you what Ray's actual portfolio looks like because I think that context matters. Bridgewater Associates filed their Q3 2025 13F with the SEC. That's the quarterly disclosure of their U.S. equity holdings. And the portfolio is massive, $25.53 billion spread across more than 1,000 positions. Their largest holdings, index ETFs. The iShares Core S&P 500 ETF is 10.62% of the portfolio. SPDR S&P 500 ETF is another 6.69%. Then you've got positions in Alphabet, other megacap tech, various sector ETFs. It's a very diversified, macro-driven portfolio. Bitcoin isn't in the 13F filing because it's not a U.S. equity security, but we know from Ray's comments it's around 1% if we're talking about his personal portfolio. Compare that to the 15% he suggests for gold and inflation-protected assets. The portfolio is weighted toward proven, liquid, diversified exposures. Bitcoin is a tiny speculative sleeve. And I think that's actually the model most sophisticated investors are following. They're not going zero crypto. They're not going all in on crypto. They're taking small, controlled exposures that give them optionality without creating catastrophic risk. Now let's talk about the immediate market context because timing matters here. Ray made these comments on November 20, 2025. At that moment, Bitcoin had just dropped below $90,000. It had been ranging between $88,000 and $93,000. It's down about 28% from its all-time high in October 2025 when it hit $126,000. So you've got Ray coming out and saying, I own Bitcoin but I won't buy more, at a moment when the price is already down significantly. That timing probably wasn't an accident. Ray's also talking about broader market concerns. In the same interview, he said the US economy is about 80% into a bubble similar to 1929 and the dot-com era. He's worried about AI valuations. He's worried about debt levels. In that context, his Bitcoin comments make more sense. He's not singling out crypto as uniquely risky. He's saying, everything's risky right now, we're in a bubble, be careful with concentrated bets on anything. And Bitcoin, given its structural concerns, is something I'm especially cautious about increasing exposure to. That broader macro view matters. Ray's not evaluating Bitcoin in isolation. He's evaluating it in the context of where we are in the economic cycle. And when you think we're 80% into a bubble, you don't add to speculative positions. You protect what you have. Here's what I think the average investor should take away from this. First, 1% is not zero. If you're completely dismissing crypto, you might want to ask yourself, what if Ray's right that there's enough chance of success to warrant some exposure? Even the skeptics are holding a little bit. Second, 1% is also not 10% or 20% or 50%. If you're heavily concentrated in crypto, you might want to ask yourself, what if Ray's right about the structural concerns? What if quantum computing does become a problem? What if reserve currency status never happens? Are you positioned to survive being wrong? Third, think about allocation as buying optionality. You don't need to go all in on either the bull case or bear case. You can hold a position that says, I see both sides, I'm not sure who's right, so I'll take enough exposure to benefit if it works, but not enough to devastate me if it doesn't. Fourth, understand the difference between speculation and strategic allocation. Ray's not treating his 1% Bitcoin as a trade. He's not trying to time the market or catch the next pump. He's held it forever and has no plans to change the allocation. It's a strategic position based on his view of the long-term possibilities and risks. That's very different from someone who's trading in and out trying to catch moves. And fifth, pay attention to the structural concerns Ray raises. Not because he's necessarily right, but because they're serious questions that deserve serious answers. The quantum computing threat is real even if it's decades away. The traceability issue is real even if most people don't think about it. The reserve currency question is real even if it's not the only use case for Bitcoin. Crypto people can't just dismiss these concerns. They need to have good answers. And if the answers are, we'll figure it out when we get there, or that's not a problem because X, fine, but at least engage with the substance of the critique. Now I want to talk about something Ray said that I think got lost in all the quantum computing controversy. He said, Bitcoin has proven itself. It hasn't been hacked. It stood the test of time. That statement is actually pretty significant coming from Ray Dalio. He's acknowledging that Bitcoin has survived things that could have killed it. Multiple government crackdowns, mining bans in China, exchange failures, bear markets, competing cryptocurrencies, scaling debates. For 15 years, people have been predicting Bitcoin's death, and it keeps not dying. That durability matters, that resilience matters, and Ray's giving it credit for that. He's not saying Bitcoin is doomed or worthless. He's saying it's proven it can survive, but that doesn't mean it's going to become what the bulls think it will become. There's a middle ground between Bitcoin goes to zero and Bitcoin becomes the world reserve currency. That middle ground might be Bitcoin becomes a non-governmental store of value used by individuals, corporations, and some smaller nations. It becomes digital gold for certain use cases. It holds value over time. It provides optionality against government currency debasement, but it doesn't replace gold. It doesn't become the foundation of the global monetary system. And in that middle ground scenario, owning 1% makes perfect sense. You're getting exposure to the upside without betting your entire portfolio on the most extreme bull case. I also think it's worth noting what Ray's not saying. He's not saying don't own Bitcoin. He's not saying it's a scam. He's not saying it has no value. He's saying I own some, I've held it for a long time, but I'm not adding more because of these specific concerns. That's a nuanced position, and nuance is rare in crypto discussions. You're either a maximalist who thinks Bitcoin is going to $1 million and everything else is irrelevant, or you're a skeptic who thinks it's all going to zero and anyone who owns it is a fool. Ray's neither of those things. He's in the middle. And I think most sophisticated investors are actually in the middle too. They're just less vocal than the extremes. Let me connect this back to Ray's broader investment philosophy because I think that context is crucial. Ray's famous for his all-weather portfolio, right? The idea is you build a portfolio that works in multiple economic environments. You don't bet on one scenario. You balance your risk across different possibilities. That same thinking applies to Bitcoin. Ray's not betting that Bitcoin definitely succeeds or definitely fails. He's saying there's uncertainty, so I'll position for both outcomes. 1% gives me exposure if it succeeds. 99% elsewhere protects me if it fails. That's how professional investors think about asymmetric bets. They're not trying to be right about the future. They're trying to position so they do okay regardless of which future happens. And here's the thing, this approach isn't exciting. It doesn't make for good Twitter content. You can't pump your following by saying, I own a small, strategic allocation to Bitcoin alongside a diversified portfolio of other assets. That's boring. People want you to say Bitcoin is going to 1 million or Bitcoin is going to 0. They want extreme predictions. But extreme predictions are usually wrong, and the people making them are usually broke. The people who get rich are the ones who manage risk, who think probabilistically, who position for multiple scenarios. That's what Ray's doing, and I think that's what most people should be doing too. So here's my challenge to you. If you own Bitcoin, ask yourself, what percentage of my net worth is in crypto? Is that a strategic allocation, or did it just grow because the price went up and I never rebalanced? Would I survive if it went to 0? Do I have good answers to Ray's concerns about quantum computing and reserve currency status? If you don't own any Bitcoin, ask yourself, am I being intellectually honest about the possibility that I'm wrong? Is there a non-zero chance this becomes important? Should I consider a small position just for optionality? Most people won't be honest with themselves about these questions. They'll just double down on whatever they already believe. But that's not how you build wealth. That's how you blow up your portfolio. Ray Dalio has spent 50 years building the most successful hedge fund on earth. He's made mistakes. He's been wrong plenty of times, but he's survived. And he's survived by being willing to hold multiple perspectives simultaneously, by updating his views when facts change, and by positioning for uncertainty rather than betting on certainty. The 1% Bitcoin position is a perfect example of that philosophy in action. It's not a bold call. It's not a hot take. It's careful risk management wrapped in intellectual humility. And honestly, that's probably worth more than all the price predictions and moon memes combined. All right, I want to hear from you. What percentage of your portfolio is in Bitcoin? And more importantly, can you articulate why that's the right percentage for your situation? Not what some influencer told you, not what would sound cool on Twitter. What's actually right for your risk tolerance, your time horizon, your financial goals. Drop a comment below. Let's have an actual discussion instead of just tribal warfare between crypto maximalists and no-coiners. And if this video made you think differently about portfolio allocation and risk management, hit that like button. Subscribe if you haven't already. We're doing deep dives on Ray Dalio's investment philosophy every week, and trust me, the next one is controversial. We're going into his succession planning disaster when he tried to step back from Bridgewater and the whole thing nearly imploded. I'm your host for Legendary Investor, Ray Dalio. This has been the story of why one of the world's most successful investors holds exactly 1% Bitcoin and refuses to buy more. And I'll see you in the next one.